Procter Gamble, a company I hold in my own portfolio, is down 5% just this week. But is it undervalued? Is its intrinsic value going to show us that it is a buy now? And what are the reasons for this drop? Let's take a look. So we can see Procter & Gamble are going to record up to $2.5 billion in Gillette write-down. Now, for those that effectively don't know, Gillette is their grooming business, and we can see that Procter & Gamble, they did buy this for around $57 billion in 2005, and they get around 8% of their total sales from this grooming business. Now, they do expect it to grow in the range of around 5% year on year, and what we can see, this isn't the first time they have taken a charge. In 2019, they took an $8 billion charge on this due to currency fluctuations, and they do say they are expecting charges of between $1 to $1.5 billion after tax related restructuring of its Argentinian and Nigerian operations. And the reason for this, as is typical, is due to macroeconomic conditions. And when we take a look here, we can see that they essentially blame the US dollar denomination of the company, and therefore these fluctuations are something that are continuing. And what they are effectively looking to do is to divest into its fabrics and home care business in Argentina and turn Nigeria into an import-only market. So total charges will be around $2 billion and $2.5 billion after tax, and they will recognize this over the next 2 years. Now, this is a company that year to date is still down around 4%, but over the last 10 years, if you had invested in Procter & Gamble, you would be up around 77%. Remember, it doesn't include those dividends reinvested, and we do see it hit its all-time high of around $165 towards the beginning of last year. Now, it is trading towards the mid-range and does offer a yield of 2.6%, but how strong is this business? Now, let's take a look, especially with their earnings. Now, in terms of their top line, what we look for is 3 to 7% growth year on year. $68 billion reported in June 2019, $82 billion in June 23, so that is positive to see. There is some nice growth on their top line. And on a more granular level, we do see increases year on year, which is always positive to see, increasing over the 5-year period as well. And we'll shortly look at the last 10 years percentage-wise too. Bottom line, net income, what story does it tell us? Well, $3.9 billion reported on the bottom line in 2019, $14.7 billion in 2023. So some incredible growth on the bottom line, far outpacing their top line growth. But on a more granular level, we do see some slight inconsistencies. We see growth, essentially a huge pop from June 2019 to June 2020, and then a nice increase to 21 before a smaller increase in 22, and then essentially flat to 23. So both top line and bottom line have increased, although the bottom line does have some small inconsistencies. Now, the health of the company, total cash versus total debt, $10.3 billion of cash and short-term investments in 2019. Latest quarterly report sitting around $9.7 billion, so a small drop in terms of their cash over the last 5 years. Numerically and directionally, what does our total debt tell us? Well, total debt did go from around $30 billion in 2019 to around $36 billion. So their cash in fact has increased by 20%, whilst their total cash has only increased by slightly lower. So a little bit worrying. We can take a look when we look at their net debt to EBITDA. Now, comparing them to some of their competitors in the household products, we have Colgate, we have Reckitt, we have Kimberly-Clark, as well as a few well-known others in the industry. Year to date, including those dividends reinvested, they are one of the worst performing in the industry, down 1.3%. Now, when we extend that to the last 5 years, PG is up 77% and is one of the best performing, which does show always zoom out, never look at short-term data, but also do remember it is quite key that past performance is never an indicator for the future. Now, 63% institutional ownership, quite a significant $18 billion worth of sales shares sold, in fact, over the last 12 months, but significantly more bought over the same period. So institutions do love Procter & Gamble. It is one that they do want to hold. And what we can see, their biggest buy of 23 was in Q2 of around $44 billion. And over the last few quarters, we can see institutions buying more considerably than selling every single quarter. So positive to note, but also it isn't one we should copy before doing our own due diligence. Now, before we look at the dividend safety and other financial metrics, we can very quickly look at their earnings over the last year. And what we can see, Q1 of 2023, they beat on both revenue and EPS. Q2, again, another beat on both EPS and revenue. And Q3, another double beat. So they have beaten on both targets, EPS and revenue, over the last year on Q1, Q2 and Q3. And when we compare Q3 23 versus Q3 22, they beat on the top line in an increase of 6%, increase to the bottom line of 15%, as well as some strong increases across the board. So not only are they beating analyst expectations, but they also increased on their figures over the last year. Very positive to see. Now, dividend safety score on 99, it is very safe, 346 billion, so it is a mega cap company. And when we take a look at recessionary metrics, for those that see a recession inbound, increased during the last recession, 07-09, had average growth of the S&P around negative 9%, but they did outperform the S&P with a negative 36% versus the S&P 500's negative 55%. Now, dividend growth, fairly poor in my opinion in this year, April, 3%. I always advocate you are looking for a minimum of inflation, so 4% or more. Last 6 years, 6%, it's okay. Last 20 years, 8% more positive, and I would like to see them get back to the levels that we have seen on average over the last 20 years. One thing to note, they are a dividend king. They have been paying increasing dividends over the last 50 years or more. And on top of that, they have paid dividends without a reduction for 133 years. So that is very significant. And I don't believe that that will be broken. So very, very strong to see. Now, in terms of dividend yield theory, well, it states a company is undervalued when that current yield sits above the 5-year average. So we have our first sign of undervaluation. But do bear in mind that essentially we're not looking at any of these models in isolation, and we will draw our conclusions towards the end. And with the forward PE, it is lower than the 5-year average, so another sign of undervaluation. But you could argue on both counts that it is near to the 5-year average, so it could show some signs as well of reasonable valuation. Sector PE is slightly higher or lower than P&G, which is 22.3. We see consumer staples at 18.9. And when we look at that free cash flow, personally, below 60% is what I target, because essentially it gives me faith that management have the ability, if they want to, offer those double-digit increases. Over the large part, it has been straddling around 60 to 70%. The last 2 years it's 63%, while we expect 2024 to be around 59%. So that does give me faith so far. Then in 2024, I would like to see a minimum 5 to 6%. Free cash flow, it is increasing. It hasn't doubled over the last 10 years, but it is moving in the right direction. 3.62 in 2014, 582 in 2023, and 2024 expected 635. So there are some small increases every year, although we do note 1 or 2 years where it has dipped. In terms of sales growth, well, 2014 to 2017 wasn't the best years, in fact, for Procter Gamble. But since then, they are growing very, very small, so do bear that in mind. They are increasing at not the rate that we would like to see at 3 to 7%. So some years, in fact, they aren't even keeping up with inflation. So in real terms, that top line is decreasing. And what we see numerically, it's gone from 74 billion to 82 billion. Now, shares outstanding, they do buybacks, so returning excess cash to our pockets, 2.9 billion to 2.48. So that is one nice thing to note with Procter Gamble. ROIC, well above that 10% minimum we like to see over the last few years, in the low 20s. So that is positive, does give me faith in management and their ability to effectively allocate their capital. And operating margin and free cash flow margin, for me, this is a very positive sign, not just because it is above the minimums that we look for, but the consumer staples industry from companies that we have analysed do tend to struggle to reach these targets. So that does give me faith in this business over the last 10 years as well as forward looking. Net debt to EBITDA, now this ties in essentially to that all-important dividend safety score that we have for Procter & Gamble, which is very safe. 1.39, so signals the number of years it would take the company to pay off all of their debt net of cash on hand, and 2024 expected to go even lower to around 1.19, so very positive. Not only is that dividend very safe, but I would believe that we will see increasing dividend growth over the next few years. As always, if you're enjoying the content, values being provided, do smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And if you want to grab a copy of the valuation model we're about to run through to get to the intrinsic value and acceptable buy price of companies, then do click on that pinned comment below and grab a copy. So let's start off with Graham's valuation. We have the stock ticker, the earnings per share, growth rate per analyst estimates with that current yield on AAA corporate bonds. Now this does come to around $90, so based on Graham's valuation, that is far lower than the current value. So we do see a sign of overvaluation. But remember, we're not looking at any of these models in isolation. We then have the multiples valuation model. We have Colgate, Kimberly-Clark, Church & Dwight companies we analyze. We get their average PE multiplied by the earnings per share of PG to get a stock price of $240. Now that is well above the current trading price and in fact above the 52-week high. So this does show signs of undervaluation in the current market. We then move on to the DDM model where we have the yearly dividends, their growth rate. Average of 5.74, I've effectively gone for bang on average. Again, if you grab a copy of the model, you can play around with these numbers and put in what you believe. So this comes to $178, and as we can see, that is significantly higher than the current trading price and above the 52-week high. So again, we do have another sign of undervaluation. We then move on to the DCF model with our free cash flows year on year. Average growth rate around 5%, forward-looking, analysts estimating around 10%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding to get a DCF price of $179. Now again, that is still some nice upside to the current trading price above the 52-week high, showing signs again of undervaluation. So intrinsic value is just the average of the models that we have gone through, which are all four for today's episode, coming to $172. Now with the current price sitting around $145, although it has come slightly lower now, we can start off with a margin of safety of 10%. Now I would use 10% if I believe the company had effectively a wide moat, strong financial metrics, good forward-looking data, and there are people who will use 10% for Procter Gamble or who believe it does trade at a premium. If you were looking at 15%, that is effectively, as we can see, because the price is now effectively 75, at trading at a 15% margin of safety. So you could argue right now that if you wanted a 15% margin of safety, right now would be a good price to pick up shares. For those who are looking even lower at 20%, it would be 137, and we can see that is slightly higher than the 52-week low. Now those who are looking at 25%, it would be around 128, 129, and personally this is probably where I would look to pick it up. I have enough shares right now, but if it does come down to the high 120s, it is where I will start to add more. In terms of Wall Street, well, they believe the share price to go up, not as high as our intrinsic value, but around $166 over the next 12 months. As always, though, let me know your thoughts. Is Procter & Gamble a one that you added on the dip? Is it one that you believe will come down even lower? Or do you just not like that over the next 10 years, you don't believe their sales will be increasing, even in a minimum in line with inflation, and therefore it is one you will not be adding? Don't forget, if you enjoy the video, smash the like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. If you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or watch list, then do click on that pinned comment below. As always, have a great day and catch you all in the next episode. Take care.